What's up, Tim?
Hey, happy Monday, guys. Or is it? It might not be.
Might not be the happy Monday,
maybe
but
just say hello.
yeah,
Just say hello.
just to say
See ya.
hello,
Tim. It kind of just feels like the financial crisis. You traded these markets back then. I mean, it obviously isn't spread to everything here, but in these regional banks, I'm looking at FRC down 62% here right now. I'm looking, at Comerica Bank down 19% here this morning. I mean, even the majors getting hit here this morning. Bank of America's trading down almost 5% here. I mean, this feels kind of like back days during 2008 when we were worried about the banking system here. How did this happen so suddenly? And what does the market structure say about all of this now?
Well,
big questions to start.
It is. It reminds me of a line by the character Mike from Ernest Hemingway's book "The Sun Also Rises," and the character, they're sitting in a bar, as is always the case in a Hemingway book, and he says, "How does a man go broke? Two ways: slowly, then suddenly." And it's a fitting line, because what causes things to all of a sudden fall apart is the culmination of much of what preceded it. I mean, you ask him, it's an enormous question. All right. First of all, so are we in the middle of a financial crisis? Not yet. The way that this happened is pretty. It's a fairly simple thing. If you're, and of course, so much has been written about this, so I will just put this in very simple terms. If interest rates are depressed for a very long time, and banks loan out money, Silicon Valley Bank loans out money. By the way, it's not Silicon, just like it's not Oregon. I grew up in Oregon, and I lived for 17 years in California. I've spent a lot of time in Silicon Valley. I've known Megan, I'll leave off her last name, for 15 years, who's the head of investor relations at Silicon Valley Bank. She's a force in our profession. So this is a personal matter. This is a sudden destruction of somebody's career job. She'll be fine, but it's a dramatic thing. But if you're lending out money at 3%, and you need to pay 5% to keep your deposits because that's where interest rates have gone, you're upside down financially. And the moment that confidence breaks down, you're in trouble. And that's a 40-year-old bank. It was started in 1983. I've been aware of Silicon Valley Bank my entire adult life. It was one of the first things that I recognized as a core component to the financial ecosystem of Silicon Valley. So it's a reminder that things are tenuous, and failure is a part of the natural order. And my bigger concern here is that we don't fall all over ourselves to prevent it. We've got. I feel bad for folks. Just keep in mind that these are the richest folks on the planet who are providing the money behind Silicon Valley Bank and its depositors. I don't want anybody to fail, but I think we have to be very careful about making everything a government backstop, because if it is, then we don't have any failure at all. And failure is necessary. If you don't have failure, if you don't thin the herd, the whole herd expires, and we're walking a rail here in how we approach these things.
Safe to say, Tim, that maybe we are setting a very dangerous precedent here.
100%.
Possibly, yeah. Quite possibly. The government cannot prevent failure; it can only absorb it. And there's a great way to see this, and everybody can do this. You can go look at the Federal Reserve's excess reserves in 2007. They were $7 billion. That is the money that was parked at the Federal Reserve that banks didn't have other things to do with. You have to keep a certain amount of reserves. The banking system in the United States is very, very heavily regulated, stipulating that you're in Canada, Dennis. The U.S. banking system is heavily regulated. Silicon Valley Bank had regulators, had oversight. But today, the reserves at the Federal Reserve, the excess monies that banks don't have a better purpose for are still $3 trillion. And then there's an additional $2.6 trillion that the Fed has out in what are called reverse repurchase agreements. So we are awash in money. That is the principal problem. The problem here that has created the collapse of Silicon Valley Bank goes all the way back to incorrectly valuing money. When you turn money into a commodity, people get very comfortable. They are unaware that they should bear some responsibility for the risks in the system. Money floods everywhere. We get confused about scarcity and choice because there's no scarcity. And then something fails and we think we have to save it. And what will ultimately be at risk if we're not careful here is the United States balance sheet. And we should be very aware that the United States balance sheet cannot absorb everybody's failure. We're not talking about market structure here, I realize. But by the way, I had many conversations with the head of IR at Silicon Valley Bank about market structure and how the market works.
All right, let's start taking a look at was the writing on the wall before this happened, Tim, right? I mean, this is another brick in that wall, but let's talk a little bit. Was the writing on the wall before this happened?
Well, and look, can anybody say rightly, could anything have prevented this risk? I've still got exposure to the market. It's my, I've got positions that are down because I certainly did not see this coming. But the data did give us clues. They were there. I looked at them. I did not appreciate them. I'll show you two things. And it is the nice thing about being aware of market structure, folks, because even though I overlooked this, the data didn't. It was there to be seen particularly in the financial sector. And I'll show you what I mean. And so you can always look at this. So market structure, by the way, is really taking the rules. The stock market is also heavily regulated. It's taking the rules and using those to understand supply and demand. And so green, demand, gray, supply. And you could look at it everywhere. So here's what I'll show you two things, and then we can look at some of these stocks. But this is what the financials were doing. And I just went right past it. I went past the fact that demand was barely clinging to 5 in the financials, and supply was exploding. It was way beyond 50%. So more than 50% of the trading volume in the hundreds, we have 506. It's probably pretty close to the GICS sector data from the S&P Global, because we licensed that data. That group was over 50% short heading into this. So there were already a lot of bets that were short on financials, and I just kind of whizzed right by that. I didn't give it good. I didn't give it the due that it deserved. And then my short beta portfolio, which is looking for things with rapidly deteriorating supply and rapidly deteriorating demand and rising supply, look what was leading. Financials. And again, I just didn't really see that because I don't short stocks. I short the market. I use SH routinely. That doesn't move a whole lot, but it doesn't have to. You can get in and out of it in great size. It's an ETF. It's a derivative. ETFs are derivatives, but it's very easy to get in and out of it. No, they're pooled funds. No, they're not. They're not. They're a substitute. The assets will be owned by whoever sponsored the ETF, not by you. You will own an ETF, which is a substitute, but it's a very liquid vehicle. There were two signs right there that were telling us there were trouble. There were troubles in the financials group. And ironically, on Thursday morning, I actually tweeted before the market opened, is SIVB or are SIVB and Credit Suisse, which is down 65% over the last year, is trading at 260. Are they canaries in the coal mine? I don't know if that's true, but clearly one of them's gone. Now we've lost two banks. Signature Bank's gone too. But What was there? It can happen so fast. It is
So
blinding speed, right? So we could look at the fact that the tech sector was experiencing layoffs where the rest of the market wasn't. Almost every day there was a tech company announcing layoffs.
Mm-hmm.
So
Now, what's next, right? I think that's what everyone wants to know. What's Market Structure Edge telling us? What's next, or what could possibly come, especially with, I think, option expiration coming?
Quad
Right.
Witch, Tim. Yeah, I mean, a period where you get extended volatility on top of it. We had to roll over last week in the contracts, but possible surge for stocks with this expiration looming. It sure doesn't feel that way right
it
now.
sure does not feel that way. One thing I want to point out about Silicon Valley Bank, because was there a sign that it was going to fail? Guess where it occurred? There was a sign. And it occurred at February options expirations. How could you tell? Look at the big spike in short volume, the supply side. It jumped all the way to 62% of the trading volume, and demand fell off the cliff. This is where the people who knew the most bet short. And they were right. A lot of folks covered by the beginning of March, their short volume was back down to 46%. But that's where the bets were. Now, as to what's coming, the first thing to look at is broad market sentiment. What is the broad market doing? And there is good news and bad news. The good news is demand had actually bottomed and is rising. Now it's rising weekly. And supply had come down dramatically. The bad news is supply market-wide in the S&P 500, which rose on Friday, is over 50% of the trading volume. So over 50% of the volume in the entire S&P 500, which is, call it 85% of market cap, is short, borrowed, manufactured. There is a lot of that is trading exemptions by market makers, but those are challenging conditions. On Thursday, was it Thursday? It was Friday. On Friday, believe it or not, the momentum portfolio, which is math looking for sharply diverging supply and demand, jumped up to 17 components, and the market fell apart. Now, the head of the open today, it's back down to 8. Does that signal a 1 or 2 day surge before we have more trouble? I think so. I don't know what's going to come, Mitch. I certainly don't like the high level of short supply or short volume supply in the market. Weak tops precede drops. If demand can't get back to 5 and it's 4.6, 5 is the bare minimum for markets to rise. Over the last decade, the market has averaged about 5.5, and that means there's consistently been more demand than supply. Well, we're clinging to that, so it won't surprise me. It won't surprise me if we have 1 or 2 good days in here into options expirations, because there'll be an opportunity. There's an opportunity to buy low and sell high, very short term into expirations. We'll see. After that, we're going to have to assess. By the way, this options expirations period is split into 2 weeks. It usually goes Wednesday, VIX expirations, Thursday, index options expirations, Friday, quad or triple witching, and indexes rebalance too. This is big quarterly S&P 500 index rebalance. Volatility really wrecks those things. And this time it's Thursday, Friday. Then we have new options trading a week from today. Banks will square the books on Tuesday, and Wednesday, right when the Fed announces its policies, is it going to continue to hike rates? VIX options, volatility as an asset class expires. I think this could be a really potentially tumultuous period.
So what do you look at? What's going to be on your radar today, Tim? I mean, obviously I haven't been updating the S&Ps because it hasn't
Just
been
keep
pretty
falling.
here. Yeah, we just took out the low for the year, folks. Our January 3rd low was 38.49 and a quarter, and we eclipsed that by a good Tim handle. So Tim, how do you approach? Like, what do you got up on your screen? What are you going for?
Yeah, well, in combat, people smoke cigarettes. So I would look for.
So we're gonna go to the store and get a pack of cigs. What do you smoke?
Find your
Philip
smokes.
Morris.
You look at PM or BTI.
Marlboro. You look
I
like
would
a
take-
Marlboro man, Tim. Tim, you look like a Marlboro man.
You know what
to
they
me.
call those? Cowboy killers.
Cowboy
man.
killers.
Cowboy killer is nice.
There was a brief period during my wayward youth when I smoked a few Marlboro Reds, but that was a long
Yeah,
time
those
ago.
are them.
man.
Yes.
That's the
Oh.
cowboy killer right there.
Oh boy, it make your head
That's a long,
spin,
long
man.
time ago. So we low volatility. You would go to low volatility, and I put a couple of those here in the Benzinga March 13th category or portfolio. Notice that demand's rising, supply is falling. Those are the conditions you want. And by the way, you could probably just go buy a Staples ETF and do all right. If you look at this low volatility portfolio, it is almost wholly comprised of consumer staples. All consumer staples. There's one tech in here, but it's not great. That is actually MasterCard, which is shifting, by the way. A bunch of these things treated as tech. Visa, MasterCard, I think SoFi, a bunch of that stuff right in the middle of this. They're coming out of tech and shifting to financials. Can you imagine? I mean, it's really unfortunate, but S&P has made some changes to the configuration of tech and financials, and what a terrible time for it. But clearly, consumer staples are the way to go. You want stuff basically that is top to bottom at 5 and has less than 50% short volume. That stuff is where the money will go for shelter. And I would look at BTI. There's one. We'll look at the market structure for it. Believe it or not, the best one, although I don't love to have low volatility stocks that are up here at 9, is Kroger. Kroger's in this deal to buy Albertsons, which also owns Safeway, and it's actually very appealing. If you look at this market structure, rising demand, falling supply. See this? If anything moves today, it's probably Kroger. It's probably a pretty good stock to be in. I would again say BTI, British Tobacco. The structure is a little bit better in this than in Philip Morris. Look at that, very solid. Don't trade price. Price is capricious. Trade supply and demand. Those are not capricious. They're predictive. And so demand is very steady, and supply fell, particularly the last 2-3 days. And that tells us this is now part of low volatility portfolios that people are going to use to ride out the potential difficulty ahead. So that's a great way to see it to me.
All right, like always, you guys see all these different areas. You guys can get on your dashboard right now. Just go to Market Structure Edge, check it out. Get your free trial today. Like always, this is available to you guys, and you guys can get a 1-month free trial. So definitely check that out. At least give it a whirl. See what you guys think. And of course, if you guys do go ahead and get that trial, reach out to Tim. You guys need a little help on learning, and there's different videos on there that you guys can learn how to master Market Structure Edge also.
Come join we fill every chair every week at the Thursday 2:30 p.m. Eastern time live demo. I host them myself, and we just answer a bunch of questions and talk about using the data. So grab a spot. Just hit the request demo button at marketstructureedge.com. Sign up for the one on the 16th, and I'll see you there.
There you go. We'll see you guys on there. Market Structure Edge. We'll have you back on, Tim. Have a good one.